Hello and welcome to the All About Condos channel. This is part 2 of Understanding Condo Financials. It's all about the money series. Brought to you by Ickbens International Realty. I'm your host and condo consultant Octavio Rueda, here to continue guiding you through the essential financial documents every condo owner or buyer should understand. In this video, we'll cover the remaining 4 key essential documents: the balance sheet, cash flow statement, accounts receivables, and accounts payable. And we'll also explain the concept of cash and accrual accounting. Let's get started. Now that we've covered the format and review of the budget and comparative income statement, it's time to shift our focus to another important financial statement, the balance sheet. While the budget and income statement deal with past and projected future financial activities, the balance sheet presents a description of the association's financial conditions at a specific moment in time, what I call the here and now. Let's take a quick look at the format of the balance sheet, what to look for when reviewing it, and how it can be used to provide a complete picture of the association's financial health as of the date of the balance sheet. As you may already know, this is what a standard balance sheet looks like. The balance sheet is given that name because it balances the equation assets equal liabilities plus net worth. This means that the total amount of assets listed on the sheet should be equal to the sum of liabilities and owner's equity. Similarly, if we rearrange the formula, we have assets minus liabilities equals net worth, which means that when you subtract the total liabilities from the total assets, you're left with the total value of the owner's equity or net worth. This is what makes the balance sheet such an important tool for assessing an association's financial health. And so, as per the formula, the format of the balance sheet is divided into 3 sections. Assets are things that the association has that are valuable and can be used in its operation to generate income or use or convert it to pay debts. These line items are some examples of assets. Cash in bank accounts. All associations have an operating account and, of course, a reserve account if it has a reserve. Another common bank account, not shown in this example here, is a security deposit account where the rental security deposits are held in escrow. In terms of other assets, some line items will be account receivables, which is money due to the association, typically from unit owners. Allowance for bad debts is money that the association sets aside to cover any uncollectible amount due from unit owners. Prepaid insurance is the unused portion of the association's insurance premium paid to the insurance provider. Prepaid other is a general category for any other money the association paid in advance for example, a deposit paid to a vendor for a job pending completion. Liabilities are monies that the association owes or borrows that must be paid, for example, bank loans. Accounts payables is money the association owes to service providers for bills not yet paid. Prepaid assessments is money unit owners paid in advance for their maintenance fees, which is typically reflected as a credit on the unit owner's ledger. Similarly, security deposits is money issued to the association by tenants or unit owners who are landlords, which is subject to being refunded at the conclusion of the rental. And reserves, as we discussed, is the amount of money the association is required to set aside as per the reserve schedule. And then we have the owner's equity section, which shows what the association would have left over if it were forced to pay down all its liabilities at that point in time. In the for-profit business sector, this section is often referred to as a net worth or capital. There are a couple of other things I'd like to point out about the format of the balance sheet. First, many condo associations use the fund accounting format when preparing their balance sheet. This format simply separates the operating transactions from the reserve transaction, adds a total column, and uses line items like due to and due from to describe any transactions between the two accounts. The other thing is that balance sheets are often formatted as comparative statements, meaning that additional columns of prior period figures are added to the sheet to compare and analyze account balance variances from one period to another. This makes the comparative balance sheet a useful tool for evaluating the association's financial position and ability to pay its debts, particularly when compared year over year. So when you're looking at a condo association's balance sheet, there are a few signs that the association might be having financial difficulties. These are cash and reserve fund balances, accounts receivables, and accounts payables. Let me show you some examples. Cash balances. This is important because the association needs to have sufficient cash on hand to operate. The industry standard is to have 2 to 3 months worth of expenses. You can calculate this amount by looking at the total monthly expenses on the income statement and doing the math. For example, let's use our January income statement to see our operating expenses. So if operating expenses are approximately $27,000, the association should have approximately $54,000 or more in its operating account. Similarly, the association should have a cash reserve balance that corresponds with the reserve schedule. So let's take a look at the reserve schedule. And we see that the estimated fund balance is approximately what is on the balance sheet. Accounts receivables, the amount of money owed by unit owners. It's important to take a close look at the receivables because it gives an idea of how well the association enforces its collection policy. The extent of the amount due can affect the bank's willingness to lend money to purchase a unit in a condominium with a high rate of delinquency. Accounts payable, the amount of money the association owes to its vendors, service providers, and lenders, if any. A high amount of accounts payable could indicate that the association is struggling to pay its bills and may be facing financial difficulties, which could ultimately impact the quality of services provided to the unit owners by causing disruption in the association's day-to-day operation. We will revisit the topics of accounts receivables and accounts payables and explore them in more detail after we've explored the next two topics. All right, now that we have covered the format and review of the balance sheet, I want to talk to you about the cash and accrual accounting method and then the cash flow statement. Cash and accrual accounting are two methods used to record financial transactions. Both methods have their advantages and disadvantages, and different businesses may choose to use one or the other depending on their specific needs and circumstances. For example, most medium and large condo associations prepare their condo statements and balance sheets using the accrual basis, while the cash basis is more commonly used by condominium associations with 50 units or less. It's important to understand the differences between cash accounting and accrual accounting, so I will do my best to explain the concept without getting into a detailed explanation that goes beyond the scope of this tutorial. Cash accounting is a method of accounting where income is recognized when received in cash. For example, when a unit owner pays their monthly maintenance fees using cash, check, or credit card, the condo association recognizes the revenue at the time the payment is made, and the payment received is recorded as a cash receipt. Similarly, when the condo association needs to purchase a product or service, the expense is recognized when it is paid. This could be through using a check or a debit card to pay bills. The money is taken out of the bank account either when the check clears or immediately when paying with a debit card. With this method, the association only recognizes the expense when the payment is actually made, regardless of when the product or service was initially purchased or used. An example of the accrual accounting method is, for instance, when a unit owner pays their maintenance fees in advance of the due date. For example, making the payment on the 20th of a month for fees due on the 1st of the following month. The association, upon receipt of the payment, records the funds as a credit to the unit owner and then simultaneously records it as a liability or debt under its prepaid maintenance account. This is because the income isn't actually earned until the maintenance payment is due, which is on the 1st of the subsequent month. Similarly, when an association's vendor submits an invoice due upon receipt for work performed on January 10th, for example, but payment is not made until March, 60 days later, the association records the expense upon receiving the invoice on January 10th and reports it in the January financials, even though the actual payment is made in March. One way to determine if a condo association is using cash or accrual accounting is to examine the reported maintenance fees in the income statement. In associations using the cash method, the income statement reflects varying amounts based on the actual maintenance fees collected during the reporting period, be it monthly or quarterly. In contrast, an association using the accrual method will show a consistent maintenance fee amount each period, with any uncollected fees appearing under the accounts receivable in the balance sheet. In summary, cash accounting records transactions in real time when cash is received or paid. Accrual accounting records transactions when they are incurred, irrespective of when cash is exchanged. It's a subtle difference, but it can make a big impact on the association's financial statements. I hope that the examples I've provided have helped you better understand the concepts of cash and accrual accounting. Next, let's do a quick overview of the cash flow statement. Understanding how the cash flow statement is derived or functions is not as straightforward or intuitive as the other statements we have been discussing. It's, however, worth mentioning and showing you the cash flow statement, as it shows how the association's funds flow in and out of the organization over a specific period of time, such as a month or a year. It helps to identify the association's liquidity and financial stability by showing whether the association is generating enough cash to meet its financial obligations. The information and format of the cash flow statement are based on three key components of the association's financial activities: operations, investing, and financing. These three components provide a breakdown of the sources and uses of the association's cash during the period of time covered by the statement. Under the operations, we find the amount of cash generated from or used for operating activities. This includes cash receipts from unit owners, which are the maintenance fees and other fees paid by unit owners, and cash paid for supplies and equipment purchases, general operating and administrative expenses, wage expenses, and funding the reserves. Under investing, we find the amount of cash used for investing activities. This includes a capital or a reserve expenditure. In this statement, we have cash receipts from sale of equipment and cash paid for purchase of clubhouse furniture. In the financing, we find the cash received or used for financing activities, such as cash receipts from borrowing cash, pay for repayment of loans. Net increase in cash is a positive $4,041. As with any other properly managed enterprise, it's always a good thing for a condo association to have a positive cash flow at the end of the year, as minimal as it may be, if it doesn't negatively impact the association's operation. So this condo started the year with $48,537 in cash, and at the year end, it had $52,578. When reviewing the cash flow statement, there are a few key points to focus on. Operating activities. It's important to ensure that the association is generating enough cash flow from its daily operations to meet its financial obligations. Investing activities. It's important to track this because it shows how much money the association is using for long-term projects and improvements. Financing activities. It's important to track this because it shows how the association is managing its debt. The cash flow statement is different from the income statement and balance sheet because it focuses on the flow of cash rather than on the association's income reported in the income statement or the net worth reported on the balance sheet, both of which are reported using the accrual method. Let me also point out that this statement is also prepared in a fund accounting format. Let me show you an example. As with the balance sheet, the operating and reserve transactions are accounted for separately. Overall, the cash flow statement is an important financial document that helps the association understand its financial stability and identify potential financial problems. By reviewing this document, the association can make informed decisions about how to manage its finances. Now that we've concluded with the cash flow statement, let's move on to a brief overview of the accounts receivables aging report. After that, we'll conclude the tutorial with an overview of the accounts payables aging report. As you may recall, when discussing the balance sheet, I said I would revisit the accounts receivables line item in the assets section of the balance sheet. In the context of condo associations, accounts receivables mostly consist of unpaid balances by unit owners. The report on accounts receivables, also known as the delinquency report, provides a list of unit owners who have not paid their maintenance fees or special assessments, if any. The board of directors and management use this report to determine which unit owner's account needs to be put into collections. As you can see, the format of the report is made up of columns that identify the unit, the name of the owner, the number of days in arrears, and the total amount due and owing. For units in the first column, it is common practice to send a notice of past due payment to unit owners within 10 days of the due date. Unit owners who are in the second column, who are 31 to 60 days past due, are generally issued a second notice of past due assessment with a warning of a possible legal action for failure to pay within the indicated time frame, usually 30 days. Unit owners whose accounts are past due for more than 90 days may be subject to having a lien filed against their unit and risk possible foreclosure proceedings. Ideally, there will not be any unit owners past due more than 90 days. However, it is not uncommon to find one or two unit owners in collections, even in a well-managed condo association. If you have access to a detailed delinquency report, the primary focus when reviewing the accounts receivables report is to see the number of units past the 60-day delinquency status, and then see the total amount in arrears, meaning the total amount of receivables. To determine if the total delinquency is high, you can calculate the percentage of total delinquency. Do this by dividing the total amount of delinquent assessments due by the total amount of assessments. If this percentage intuitively seems high, you may want to examine the extent of the delinquency more closely. This can be done by calculating the rate of delinquency, which involves dividing the number of units in arrears by the total number of units in the condo or complex. First, let's calculate the total percentage of delinquency using the formula percentage of delinquency equals total amount of delinquent assessments divided by total amount of assessments due times 100. For example, if a condominium association has $7,675 in delinquent assessments and $29,000 in total assessments due, the percentage of total delinquency would be calculated as follows: 7,675 divided by 29,000 times 100 equals 26.46%. This means that the association's percentage of total delinquency is 26.5%. Similarly, using the total number of the delinquency unit, the formula is rate of delinquency equals total number of delinquent unit owners divided by total number of condo units times 100. For example, to determine the number of delinquent units, check the number of the units that are in arrears for 30 days or more. Let's not count this $25 because it's probably a late fee that has not been paid. So we have 1, 2, 3, 4, 5 units in arrears. Let's assume there are a total of 148 units in the condominium. That means we have 5 divided by 148 equal 3.38% delinquency rate. Under normal circumstances in a stable economy, a 5% delinquency rate is the industry standard for condo associations. A delinquency rate of 10% or more is cause for concern. During the economic downturn in 2008, delinquency rates of 40 to 60% were common for many condo associations in South Florida. And finally, we'll end the tutorial with the accounts payable report. The purpose of the accounts payable report is to provide a summary of the association's outstanding financial obligations to its vendors and contractors as reported in the liabilities section of the balance sheet. In other words, this report is a list of the vendors the association owes money to. This report is used typically by the board of directors and management to ensure that all the invoices are being paid in a timely manner and to identify any potential issues with the association's financial health. The format of the accounts payable report is similar to the accounts receivables in terms of labeling of the columns. We have payee name, amount payable, not yet due, 0 to 30, 31 to 60, 61 to 90. When reviewing the accounts payable report, it's important to focus on the total amount of unpaid invoices and the number of days the association is past due on each invoice. It's generally good practice for an association to pay its invoices within 30 days of issuance. An invoice of unpaid invoices or a high number of days past due may indicate financial problems within the association. However, it's not uncommon for disputes to arise over invoices, and in such cases, it may be necessary to contest the invoice or negotiate a payment plan. It's important for the association to handle any disputes or delinquencies promptly and professionally to avoid damaging its relationships with its vendors and contractors. The cash flow statement, accounts receivables aging, and accounts payable aging reports are not always made available to unit owners as part of the financial package. And be sure to ask for financials that are either reviewed, compiled, or audited by an independent accounting firm. I want to impress upon you that it's important for unit owners to stay informed about the financial strength of their association, as it can have a significant impact on the value of their property and the quality of life in the community. Always be sure to ask questions and seek clarification if you have any doubts or concerns about the financial reports of your association. Remember, as a unit owner, you have a stake in the financial well-being of your association and have a right to be informed about its financial affairs. So before we conclude this tutorial, I'd like to let you know that we're here to help. If you have any questions about your condo association's financial documents and would like for us to take a look at them and answer or help you find answers to questions you have, please submit a copy of the financial documents in question to www.reviewmycondofinancials.com, and we'll gladly review them and answer any questions you may have for free. With that, we conclude this tutorial. Thank you for watching. I hope this video has provided you with a better understanding of how to review and analyze condominium association financial documents. If you found the information useful, please show your appreciation by clicking on the like button and subscribe to our channel. We would greatly appreciate it if you did. Thanks again, and God bless.